Good afternoon, everyone. In today's video, I'd like to start off with a quick member spotlight for one of our Volatility Box members who had an absolute killer day trading the S&P futures. But more importantly, I think it illustrates the fact that you can take the Volatility Box and adapt it to your own particular trading style and use our trade plan rules really more as inputs, but still continue to take your own trades, right? That's the whole idea of the Volatility Box, is to make you an independent trader. It's to work with your own set of setups, and the trade plan is a suggested trade plan to help you get started. So this particular member, GI, to protect his identity here, he sent an email at 7:39 a.m. with the following screenshot of his S&P futures. Now keep in mind, the P&L here is really nice, but he was also trading a 10 lot, right, on the full size contract. So that's no joke, but the P&L there was 39.25 with a bounce off of the volatility box that first 30-minute period when, according to our trade plan, that's when we're still looking at information from the marketplace. That's when this particular member actually had his setup. He had his other signals as well, and that led to a really nice winner. So I sent him back an email saying, hey, can I share this with all of our members in tonight's video? To which he responds, sure, but this is the actual P&L that was currently open. And that was at 10:49 a.m., in which you can see that 10 contracts has now gone up to 32, but that P&L has also increased to a positive almost $7,000 in just one day's trading, focusing only on one market. So hopefully this gives you an idea of what A, focus gives you in terms of strength, but B, what's also possible with not only the volatility box, but also your own setups, combining the two to have a really nice day. Now keep in mind, of course, he's trading some fairly large size here. 32 full-size contracts is no joke. But you can also see how using a process-driven systematic approach still leads to some really nice winners, especially if you're able to be focused and layer on whatever your own trading style is and start to use that to profit consistently from the marketplace. So once again, just a huge shout out to GI. Congratulations on a phenomenal day of trading. Thanks for sending those screenshots. And for all of our other members, if you have similar screenshots, would love to see them because it's really nice to see other people's performance as well, just to make sure that everyone is actually getting the system. So now for the rest of the video, I'd like to talk about this idea of volatility returning to the markets, right? And we've seen that very clearly today, but for our Volatility Box members, we had actual data to back that up. What do I mean by that? Well, for example, with our Stock Volatility Box for the better part of almost a couple weeks now, for every day we've seen about 60 or so trades that's set up on our live scanner page, and that's 60 or so opportunities that you can pick and choose from. Today, that number went up to 149. Right, which was obviously much more, a little bit more than 2x. And so we had a new member ask a pretty apt question, in my opinion, which is, well, what do you really do when you have 149 trades that are setting up? There's really no feasible way that you as a human could take all 149 trades, nor should you for the most part, even though that was profitable. If you took every single trade, your entire P&L over the course of the day was a positive P&L. But with sort of the limitations that we have as being humans, how do you still maximize from those 149 trades? So I'll talk about that in today's video. The second point is around our gold futures trade. So for all of our Volatility Box members that have been with us for quite some time, you remember in the trade plan towards late 2019, I think it was, we had a specific rule around our gold futures from 6 a.m. to 7 a.m. Pacific. That's when the markets are just opening, where we're willing to buy any sort of fades to the edge because they just ended up working really well. Well, that pattern that we had put on the shelves is now, I think, time to start to look at that again. We're starting to see this pattern happen more and more frequently with the gold futures. I'll talk about today in particular where we missed out because of waiting for an edge signal, but that's where I think the idea that we have confidence in this pattern in itself, and so that could be the confidence signal in itself only during that 6 to 7 a.m. Pacific hour, that first 30 minutes when you're looking at the market open, and use that to try and pull out some money at least from the market. So I'll talk about that pattern. Next up, we also had very clear proof that the NASDAQ was the more volatile market today compared to the S&P and the Dow. And we saw that translate over to our Stock Volatility Box as well, in which we saw a good deal of tech stocks that came on our radar. Some of these examples include Twilio, Datadog, Slack, Chegg, Fastly, Zoom, Roku, DocuSign, AMD, and Splunk, right? All big tech names where we had opportunities that set up. In some of these, you even had an opportunity to enter once you got the edge signal, but it became this consistent theme that, hey, we're starting to see much more volatility in tech stocks and the NASDAQ market compared to the rest of the indices and the overall broader market as well. So I think that's information, place that you can then decide, hey, either you'd like to focus on that high volatility period, or conversely, you'd like to focus in a place where it's a little bit calmer, right? The S&P was a little bit calmer. The Dow was a little bit calmer compared to the NASDAQ. And so you can take that as whichever trading style you like. If you like to have that more volatile trading style, you may be choosing to focus on these tech stocks. Conversely, if you prefer sort of that more calm consolidation to rise, it's less stressful, you may be preferring other stocks outside of tech. So you can use that as information. And then finally, I'll conclude with some swing trade setups in TDOC, which is a bullish setup, along with General Dynamics, which is a bearish setup. So we have a lot to cover, but stay tuned because I think you'll get a good deal of information from today's video. Let's start with the first question, which is where do you focus when you have 149 entries that come up on the live scan? Well, to me, it's really simple, and I'm a huge fan of just keeping things as simple as possible in terms of rules, in terms of checkpoints, so on and so forth, right? So when we have 149 entries, my bias typically goes towards stocks that have been on the live scanner for quite some time. So that's where, let's say, the stock has been on the live scanner for 20 to 30 minutes, giving you this inclination or a bias that, hey, price is now starting to consolidate. We haven't broken outside of the clouds in the past 20 to 30 minutes. Sellers really haven't come in and sold price action way below what the current price is. And we're now expecting buyers to come in and really start to bring in some support. So the fact that they've been on the scanner longer, they're still active trade setups, should give you a little bit more confidence in the sense of, hey, the trade hasn't instantly stopped out. Sellers haven't fully taken control. In the case of today's activity, if conversely we had a bunch of short entries, then that would be opposite, in which buyers have taken control, right? But the idea is the same, in which you're looking for stocks that have been on the live scanner for quite some time, as that then gives you more confidence that in today's case, buyers are willing to come in and step up, pick up price action, and really start to move the price back up higher. So that's point number one. Point number two is to then have a bias towards stocks that you generally just don't mind owning anyways for a longer term period. So some of these include higher quality stocks such as AMD, Fastly, versus some other names that we often see on our radar, which are less known names, right? They're a little less well known. They might be cheaper stocks. They might be that $10 to $20 stock range versus something like an AMD or a Fastly, which is a little bit more established or has momentum and legs under it with the recent past activity. So that's another bias that you could add in. And finally, the third bias, which we've talked about in that energy stock video as well, is recognizing and finding these clusters of stocks that are moving together in a particular vertical and theme, which you can then start to take advantage of, because you can then find places in which, say, in this entire cluster, where do I have an opportunity to, say, enter at the conservative volatility box, whereas everything else is aggressive? What are some stronger name stocks just on the larger time frames, like a daily or a weekly time frame? So on and so forth, right? So you can find these clusters and then choose the strongest candidates inside of those clusters when you have the luxury of 149 candidates on the radar. So that's the first point, which is where do you focus when you have so many? So hopefully this gives you some of those ideas. Now the next thing that I'd like to talk about is the gold futures trade. So let's head on over to our charts. So now particularly with gold here, we had our first hour tell us that it was okay to use the aggressive volatility box. And in that next hour, that's a 6 a.m. to 7 a.m. Pacific hour, we had price action fall perfectly into our volatility box lines. We didn't even breach the clouds for that matter before we ended up having a really nice reversal point from our exact entry zone, right? The cyan entry line ends up becoming the place that you're looking at as a potential entry, and price bounced from there. Now, our rules tell us that we need to wait for this confirmation signal, and that's really a product of the recent volatility. In today's case, for example, we see that if you waited for that edge signal, you never really got an opportunity to re-enter at that cyan line or better. And so this is where I think it's important to start to observe that, hey, the edge signal today, I think for the most part, actually cost you some trades. If you're waiting for that full confidence signal, you missed out on trades, or the trade opportunities that came just didn't work the way that I think you expected them to work. So the question then starts to become, is this a repeating pattern or not? And that's something that I'd like to bring on everyone's radar, which is gold. And that 6 to 7 a.m. hour has already typically proven to be a really, really good trade. And so that, I think, serves as a pretty decent confirmation signal in lieu of the edge signal. Now, does that mean that I'm going to be taking this no matter what? No, I think I'd like to still see this prove out a few more times before we can shelf the edge signal in terms of the gold trade for 6 to 7 a.m. Pacific, where when the market's open, you're looking for gold to give you that signal instead of the S&P, the Dow, the NASDAQ as a potential reversal. And this then ends up giving you a nice 1,300 winner. Right, that's what gold was today. We're accustomed to seeing this. It's not just a one-time sort of trade, but I'd like to see that this pattern continues to repeat itself, where gold respects our aggressive volatility box, or whatever volatility box we've seen as being the one dictated between 5 to 6 a.m. Pacific, the hour in which we have to actually determine the gold volatility box. But that's trade number one, a pattern that I think everyone should keep on their radars, especially if you like to trade gold. Now, the next thing I'd like to talk about is the very clear visual representation that the NASDAQ was the more volatile market today. So let's take a look at that. If we go to a chart of NASDAQ, what you should notice is our clouds here ended up getting broken through just like that over the course of, I think it was the 8 a.m. to 9 a.m. Pacific hour. If I contrast that with the S&P in that same time frame, 8 a.m. to 9 a.m., you should see that the clouds look much, much different, right? While we are waiting for our edge signal, which we didn't get, and that became our luxury of not having to take this trade, I think it's important to see that in one case, our cloud still did a decent job of being expanded versus something like the NASDAQ, in which the clouds really looked more like that sandwich which we've described in the trade plan. That becomes that very clear visual cue of, hey, this is the more volatile market if you had to rank them in terms of the S&P, the NASDAQ, and the Dow, which if you compare the Dow in that 8 a.m. to 9 a.m., that should also look much, much different, right? Where the Dow in that hour made a move towards the edge of the clouds, the S&P broke through the clouds, but not as vigorously as the NASDAQ futures, in which we just broke through early on in the 8 a.m. to 9 a.m. hour, right? So that's where I think it's very easy to quickly assess that, hey, NASDAQ is number one in terms of volatility, S&P is second, and then Dow is the one that's least volatile. So using that, you can then decide, hey, where would my focus like to be for the rest of the day, 9 a.m. onwards? And you can see if in this case you chose to avoid the NASDAQ, you avoided a good deal of chop. You did get some really nice fade entries. And of course, you were using a different volatility box at this point, the conservative, I believe, on the NASDAQ versus on the S&P, the Dow, and I believe the Russell as well. You got a chance to be a little bit more aggressive using something like our doomsday aggressive models, in which the volatility box does a much better job of molding to current price action. And then finally, in this video, I'd like to talk about some of the swing trade opportunities. So we had our swing trade in net, which ended up being really successful. And now we have our next batch of signals. So our first one is in TDOC, in which we see we have our bullish squeeze signals. In fact, we have two. And if I load in the market pulse as well, you should notice that it is, for the most part, a bullish market pulse, right? So that should give you confidence that, hey, TDOC is looking like it's prone to breaking up to that next level. If we draw our fibs here, that should give us some decent targets that you can aim for. And so that 1272 takes you to the 217, and that 1618 takes you to the 234, at which case, if you did buy the stock, you could also start to sell a covered call whenever price does hit either one of those levels, in which you're then looking for price action to either start to consolidate here or pull back just a little bit from that 1272 or 1618 extension. So that's a trade in TDOC, which is a bullish trade, and the trade in GD is a bearish trade, very similar. But in GD, we see that we had our bearish squeeze signal happen a few days prior. We've now had an entry at the market pulse with our market pulse just starting to turn red, which is our deceleration phase, suggesting that General Dynamics is getting ready to finally break through what we would have hoped for from this signal, but instead you have a much better entry. And so that's the play if we draw the same fibs on the opposite side, but this time using our bearish scenario. We can then see that our 1272 takes us to 89.15 for that bearish first target, along with 74.65, which both end up becoming some pretty wild stretch targets. So I think a more realistic zone would be to target something like the 786 or 618 for your first batch of contracts, and then see if the runner goes to that 1272 and 1618 zone as the markets start to roll over. You also have the put call ratio in your favor. If we load in the utility labels, you should see that the put call ratio on the daily is suggesting that we're in a bearish zone, suggesting that, hey, too many people are long and we would expect that the markets start to roll over from here. So that gives you a bullish trade in TDOC, where you have, I think, just news, momentum, and the entire telemedicine working in your favor. And then you have General Dynamics, which is a short, which is accommodating to more of the overall market trend, the put call ratio, and starting to give you an opportunity to start to at least have some sort of a short position in which you have an edge at the edge. All right, so this was a long video, but I hope it was useful. A lot of good information for both Volatility Box members and non-Volatility Box members, so that regardless, you should still be able to profit, and that's really our goal. It's to be able to consistently provide you value so that you can start to make money with your trading accounts, to consistently grow them, and start to pull out profits from the marketplace. All right, hope you all have a wonderful rest of your day. We'll see you in the next update. Take care, and good luck trading the rest of this week.